On January 15th, 2026, something is going to change in the global silver market that cannot be undone. And if you're watching this video after that date, you're already seeing the consequences play out in real time. If you're watching before that date, you have a narrow window to understand what's happening and position accordingly. My name is Kenzo, and I run Frontier Analysis, where we track commodity markets using the same data sources institutional traders access. What I'm about to walk you through isn't speculation. It's not a conspiracy theory about manipulation or corrupt banks. It's a documented policy change from the Chinese government that fundamentally alters the structure of physical silver availability in Western markets. And I am going to show you exactly why this matters, what the data tells us about the ripple effects, and what 3 scenarios could unfold over the next 6 months based on how market participants respond. Here's what happened. On December 9th, 2025, the Ministry of Commerce of the People's Republic of China published an updated export control catalog. Buried in Section 4, subsection 12, is a single-line item. Silver and silver alloys now require explicit export licensing beginning January 15th, 2026. That might sound bureaucratic and boring, but what it means in practice is that any company wanting to export silver from China, whether it's refined metal silver-bearing concentrates or manufactured products containing significant silver content, now needs government approval on a case-by-case basis. This isn't a ban. Let me be clear about that. China hasn't said no silver can leave the country. What they've done is insert a control mechanism that gives them discretion over who can export, how much, and under what conditions. And that discretion is what changes everything. Why does this matter? Because China isn't just a consumer of silver. China is also a refining hub and a re-export center. Large quantities of silver mined in other countries get shipped to China for refining, because Chinese refineries offer competitive rates and fast turnaround times. That refined silver then gets re-exported to destinations worldwide, including Europe and North America. If that re-export flow suddenly requires government licensing, and if those licenses are approved slowly or denied for strategic reasons, you've just choked off a significant portion of the physical silver that moves through global supply chains. We're talking about an estimated 1,200 metric tons annually, which is roughly 38 million ounces. That's not a trivial amount. That's nearly 5% of total global mine production, suddenly subject to administrative discretion. Now, before we go further, I want to give you the counter-argument, because unlike a lot of content in this space, I'm not here to just tell you the bull case and ignore everything that contradicts it. The counter-argument goes like this. China issues export licenses all the time for various commodities. The licensing requirement doesn't necessarily mean exports will stop. It might just mean additional paperwork and modest delays. Chinese refineries have commercial relationships with Western buyers, and disrupting those relationships damages China's reputation as a reliable trading partner, which they care about because they want to be integrated into global supply chains for economic and geopolitical reasons. So maybe this licensing requirement ends up being a formality that doesn't materially impact physical flows. Maybe Western markets barely notice any difference, and silver prices don't react the way bulls expect. That's possible. I'd assign maybe a 20% probability to that scenario. But even if there's a 1 in 5 chance that this is a non-event, there's an 80% chance that it matters, and the magnitude of impact in those scenarios ranges from significant to severe. Let me walk you through why I weight the probabilities that way. First, China doesn't add export controls casually. When they implemented rare earth export licensing in 2010, it wasn't a formality. Exports dropped sharply, prices spiked, and it took years for supply chains to adjust by developing alternative sources. When they restricted gallium and germanium exports in 2023, those markets tightened immediately. The pattern is clear. When China implements export controls on strategic materials, they use those controls. Second, silver has become strategically important to China in ways it wasn't a decade ago. China is the world's largest manufacturer of solar panels, which are silver intensive. They're also the largest producer of electric vehicles and consumer electronics. All of those industries need silver. If China is moving toward a policy of securing domestic supply for domestic industrial use, especially in a geopolitical environment where technology and trade are increasingly weaponized, then it makes perfect sense for them to control outflows and prioritize domestic consumption. Third, and this is the key point, we're already seeing evidence that Chinese entities are behaving as if this policy will be enforced strictly. Between December 9th, when the announcement was made, and December 31st, Chinese silver exports jumped by 40% compared to the same period in 2024. That's a massive spike in a short window. What does that tell us? It tells us that exporters were rushing to ship whatever they could before the January 15th deadline, which implies they expect licensing to be restrictive, not permissive. If they thought licenses would be rubber stamped, there'd be no reason to accelerate shipments. The fact that we saw this surge suggests the market is pricing in reduced future availability. And when market participants front-run a policy change like this, it usually means they have better information about how the policy will be implemented than the general public does. So let's assume, for the sake of analysis, that Chinese silver exports declined significantly after January 15th. Not to zero, but let S say they drop by 50% over the next 3 months as licensing bottlenecks develop, and Chinese authorities prioritize domestic industrial users. What happens to Western markets? You lose roughly 19 million ounces of supply in Q1 alone. Where does that supply get replaced from? There are only a few options. Option 1, Western refineries increase output. But Western refining capacity is already running near full utilization, and you can't just flip a switch to add capacity. It takes months to ramp up production, and you need feedstock, which means either more mine production or more scrap recycling. Mine production doesn't respond quickly to price signals. We talked about this in previous videos. There's a 2 to 3 year lag between price increases and new production coming online. Scrap recycling can increase somewhat, but we're limited by how much silver exists in recoverable forms and whether prices are high enough to incentivize the effort. So, what are the options if Chinese supply gets cut off? Option 2 is to pull from existing inventories. But where are those inventories, really? The biggest visible stockpiles in the West are in exchange-traded funds like SLV and in COMEX warehouses. As of January 1st, 2026, SLV holds around 550 million ounces. COMEX registered inventory, which is the metal actually available for delivery, is only about 46 million ounces. Now, those sound like huge numbers, right? But here's the catch. The silver in SLV is owned by shareholders. These are people who bought shares specifically because they want exposure to silver. That metal isn't just going to flood back into the market unless those shareholders start selling. And when do they usually sell? When prices are falling, not when they're skyrocketing because of a shortage. And what about the COMEX inventory? As we've already talked about, that 46 million ounces is already facing a lot of pressure from a high number of delivery requests. So the actual buffer, the real emergency supply that could absorb a shock, is much, much smaller than what it looks like on paper. Okay, so what's option 3? Reduce industrial consumption. This is the classic market response to a shortage. Prices go up until some users just can't afford the metal anymore. They either find a substitute or they cut back on production. The problem with silver is, for many of its most important uses, there are no good substitutes, at least not with today's technology. You can't make a high-efficiency solar panel without silver. You can't replace it in certain critical electrical components without creating major safety and reliability problems. So, while some minor uses might fall away, the core industrial demand for silver is incredibly stubborn. It doesn't really change much in the short to medium term, no matter the price. So, you end up with a situation where supply drops, inventories are tight, and demand can't adjust quickly. What's the only thing left to give? The price. And this is where it gets really interesting for anyone who holds silver or is thinking about it. If my analysis is correct, and these Chinese export restrictions create even a small supply deficit in the West, the first thing you'll see is the premiums over the spot price going up. We're already seeing it happen. I checked some dealer websites yesterday. Right now, to get physical silver rounds in your hand, you're paying $5 to $7 over the spot price. A year ago, that premium was only $2 or $3. Silver bars are running $4 to $6 over spot. And government-minted coins like American Silver Eagles, they're commanding premiums of $8 to $10 over spot in some places. These premiums are a flashing red light. They're telling you that the physical market is already tight compared to demand, and we haven't even hit the January 15th implementation date for these new rules yet. Once that date passes, and if Chinese exports do drop like we expect, those premiums are going to get even wider. It wouldn't surprise me at all to see $10 to $15 premiums for retail products by February or March. That effectively means the real price of silver, and the price you actually have to pay to get your hands on it, is way higher than the number you see on your screen. Now, here's where it gets even more complex. These rising physical premiums eventually start to affect the futures markets. How does that work? Well, imagine you're an industrial user, like a tech company. You need physical silver for your manufacturing process. You see the spot price is, say, $90 an ounce, but when you try to actually buy it for delivery, everyone's charging you $105. At that point, you have a huge incentive to just buy futures contracts on the COMEX and stand for delivery rather than paying that massive premium in the physical market. This leads to a surge in delivery requests on the COMEX. As more and more people demand physical delivery, the registered inventory gets drained. This forces the exchange to do one of two things. Either they have to create massive incentives to get people to deposit more silver into their vaults, or they start seeing delivery delays and begin settling contracts with cash instead of metal. If cash settlements become common, it's a huge problem. It completely undermines confidence in the futures market as a reliable place to determine prices. This can cause a major split, where the futures price and the physical price go their separate ways. We saw a little preview of this back in March of 2020 during the COVID lockdowns. The futures market went into what's called backwardation, where near-term contracts were more expensive than later ones, which is the opposite of normal. That situation fixed itself pretty quickly because it was caused by temporary shipping problems. But what we're potentially facing now is a structural long-term supply problem. That means any market dislocations could last much longer and be much more severe. Let me give you a concrete example. Let's say you're a solar panel manufacturer in Germany. You need 50,000 ounces of silver every month. Normally, you buy from a European distributor who gets their silver from various refineries, including some in China. After January 15th, your distributor calls you and says lead times have gone from 2 weeks to 8 weeks, and the price is now 15% over spot. You can't just stop production for 2 months, so you start looking for other options. You call refineries in North America, but they're all booked up, supplying their existing customers. You think about buying from a retail bullion dealer, but their premiums are even higher. Your last resort is to go to the COMEX. You buy 10 futures contracts, which is 50,000 ounces, and you file the paperwork to take delivery. That might work once, maybe twice. But what happens when hundreds of other industrial users are all doing the exact same thing at the exact same time because they can't get their silver from China? The COMEX inventory drains, and it drains fast. And if that inventory is draining faster than it can be refilled with new deposits, the exchange has a serious crisis on its hands. What happens next really depends on how the COMEX and the market respond. I see 3 main scenarios. Scenario 1 is the orderly adjustment. The COMEX raises incentives to get more silver into their vaults. Maybe they cut storage fees or offer other perks to people holding large amounts of physical silver to convince them to deposit it. This brings more inventory into the system and stabilizes things. In this case, prices rise, but in a controlled way. Premiums stay high but manageable, and the market adjusts over 6 to 12 months as new, non-Chinese supply sources ramp up. I'd give this scenario about a 30% chance. Scenario 2 is the disorderly adjustment. The inventory just doesn't get replenished fast enough. The COMEX starts encouraging cash settlements or even declares force majeure, which is basically a way of saying they can't fulfill their obligations. If this happens, confidence in the paper silver market collapses. Physical premiums would explode, and you'd see a 2-tiered market where paper silver trades at one price and physical silver trades at a much, much higher price. I put the probability of this at around 40%. It's not my base case, but it's definitely plausible given how tight the physical market already is. Then there's scenario 3. The non-event. The Chinese export restrictions turn out to be no big deal. The licenses get approved easily, exports continue more or less as normal, and the Western markets barely feel a thing. Premiums might tick up a little, but they don't spiral out of control. I'd assign a 20% probability to this. The reason I am walking you through all these scenarios is that your decision on how to position yourself should be based on these probabilities, not on being 100% certain of any one outcome. If you're someone who absolutely cannot afford to be wrong, meaning a big drop in price would seriously hurt you financially, then even a high probability bet might not be right for you. But if you're working with capital that you can afford to have in a volatile asset for a year or two, and you understand the risks, then the probability weighted value here looks very positive. Let me try to quantify that. If scenario 1 happens, silver probably trades between $95 and $110 over the next 6 months. If scenario 2 happens, you could see $120 to $150, or even higher, as the physical market breaks away. And if scenario 3 happens, silver probably just stays in its current range, between $85 and $95. Let's do the math. We weight those by the probabilities, 30% of 100 at 2.50, plus 40% of 135, plus 20% of 90. That gives you an expected value of around $112. The current price is $89. That's a 26% expected return over just 6 months. Of course, this is all just my analysis. You have to do your own research and make decisions that are right for your own situation. But the signs are pointing to a potentially historic shift in the silver market. If this analysis is hitting the mark for you so far, toss a like on the video and subscribe. It really helps the channel. Now, let's dive into the next piece of the puzzle. Now, expected returns are useful for decision making, but they don't tell you about the path those returns might take or the volatility you all experience along the way. Silver isn't a stock that moves up smoothly. It's a commodity that can swing 5 to 10% in a single session based on macro developments, dollar strength, or shifts in investor sentiment. So if you decide to establish a position based on this analysis, you need to be psychologically and financially prepared for drawdowns. You might be up 20% one month and down 15% the next, before ultimately ending higher. That's the nature of commodity exposure. If you can't handle that volatility without panic selling at the worst possible time, then you shouldn't be in this trade regardless of how compelling the setup looks. I'm saying this because I've seen it happen repeatedly. Investors buy into a thesis, the thesis starts playing out, but they can't stomach the volatility and they exit right before the major move materializes. Then they watch from the sidelines as the asset doubles and they feel like they missed out, which creates emotional damage that worse than the financial loss would have been if they just held through the volatility. So let's talk about practical implementation. If you were convinced, or even partially convinced, that Chinese export restrictions create a favorable setup for silver, how do you actually position for it in a way that manages risk appropriately? The first decision is physical versus paper. Physical means buying coins, rounds, or bars from a dealer and either storing them yourself or using allocated storage through a vault service. Paper means exposure through ETFs, futures contracts, mining stocks, or other financial instruments that give you price exposure without requiring you to handle physical metal. Each approach has trade-offs. Physical gives you direct ownership with no counterparty risk. If you hold a silver coin, you own that silver regardless of what happens to any financial institution or exchange. The downside is premiums, storage considerations, liquidity constraints when you want to sell, and the fact that if premiums collapse even while spot price rises, your net gain might be less than you expect. Paper gives you tighter spreads, better liquidity, and easier position sizing, but you have counterparty risk, and if physical markets dislocate from paper markets in a severe scenario, your paper position might not capture the full upside. My personal approach, and I am sharing this not as advice but as transparency about what I am doing with my own capital, is a hybrid. I hold a core position in physical silver, approximately 15% of my precious metals allocation, stored in allocated vaulting through a service that provides insurance and audit reports. That's my insurance policy against a true systemic breakdown where paper claims become problematic. Then I have a larger position in SLV, which is the largest silver ETF, because it gives me liquidity if I need to exit quickly or rebalance. And I have a smaller speculative position in silver mining equities, specifically companies with low-cost production and strong balance sheets, because miners offer leveraged exposure to silver prices. If silver goes up 20%, a well-run miner might go up 50 to 80% due to operating leverage. Of course, if silver goes down, miners get hit even harder on the downside, which is why it's a smaller position and only in companies I've researched thoroughly. That's my structure. Yours might be different based on your risk tolerance, time horizon, and conviction level. Let's address the tax implications, because this is something most content creators ignore, but it matters significantly for your actual after-tax returns. In the United States, physical gold and silver are classified as collectibles for tax purposes, which means if you hold them for more than a year and sell at a gain, you pay a 28% capital gains rate instead of the lower long-term capital gains rates that apply to stocks or ETFs. That's a meaningful difference. If you're in a high tax bracket, you're potentially giving up a significant portion of your gains to taxes. ETFs like an SLV are also treated as collectibles for tax purposes, so that doesn't solve the problem. Futures contracts are taxed under a 60-40 rule, where 60% of gains are taxed as long-term and 40% as short-term regardless of holding period, which can be more favorable depending on your situation. Mining stocks are taxed as regular equities, so long-term holdings get the lower capital gains rate. I'm not a tax advisor, and you should absolutely consult with one before making any decisions, but the point is that tax treatment should factor into your position structure, especially if you're allocating significant capital. Another consideration is dollar cost averaging versus lump sum entry. If you believe the thesis I've laid out, you might be tempted to go all in immediately to maximize exposure before prices move. The problem with that approach is timing risk. What if Chinese export restrictions get delayed? What if there's a short-term dollar rally that pushes all commodities down temporarily? What if there's a macro shock that causes a flight to cash and everything sells off? If you've deployed all your capital at once and the market moves against you in the near term, you have no dry powder to add at better prices. And psychologically, it is much harder to hold through drawdowns when you are underwater from day one. Dollar cost averaging, where you spread your purchases over weeks or months, reduces timing risk and gives you better average entry prices if there's volatility. The trade-off is that if prices move up immediately and don't look back, you miss out on some gains by not being fully invested from the start. There's no perfect answer. My approach is to establish a core position quickly, maybe 50 to 60% of what I ultimately want to hold, and then add systematically over the following weeks, with larger additions if we get pullbacks. Storage is another practical issue that matters more than people think. If you're buying physical silver in meaningful quantities, you need a plan for where it's going to sit. Home storage is the cheapest option, but it comes with security risks and insurance complications. Most homeowners' insurance policies have very low coverage limits for precious metals, often $500 to $1,000, which means if your home is burglarized or damaged, you are not getting compensated for the full value of your holdings unless you purchase additional riders, which can be expensive. Professional vaulting services solve the security problem and provide insurance, but they charge annual fees, typically around 0.5% to 1% of the value of your holdings. That might not sound like much, but it compounds over time. If you're holding for 5 years and paying 1% annually, that's 5% of your position gone to storage costs, which you need to factor into your return calculations. Some people use bank safe deposit boxes, which are cheaper than professional vaulting but don't come with insurance. And there's also the question of accessibility if you need to liquidate quickly. If you go the ETF route, storage is handled for you, but you're paying an expense ratio. SLV charges 0.5% annually. That's lower than physical vaulting costs, and you get much better liquidity, but you don't have direct ownership of specific bars. And in an extreme scenario where the ETF faces operational problems, you're a creditor, not a bailee. The prospectus has force majeure clauses that allow cash settlement under certain circumstances. Again, this probably doesn't matter in normal market conditions, but if you're positioning specifically for a scenario where markets break down, it's worth understanding the fine print. My view is that for most people, a combination approach makes sense. Some physical for the peace of mind and insurance against tail risks, and some ETF exposure for liquidity and cost efficiency. The exact mix depends on how much weight you put on extreme scenarios versus normal market functioning. That's where I'll leave this analysis. There's no single correct way to approach a setup like this, and there's no outcome that's guaranteed. What matters is understanding the structure of the risk, the range of possible outcomes, and how each of those fits your own time horizon and tolerance for volatility. Silver is not a trade you win by guessing the headline correctly. It is a position you manage by thinking clearly when the narrative gets loud. For full transparency, all the data, reports, and primary sources referenced in this video are publicly available and linked in the video description below. If you found this kind of evidence-based, probability-driven analysis useful, that's exactly what frontier analysis is built for. We track theses in public, update them as new data comes in, and document what works and what doesn't. Thanks for watching, and I'll see you in the next one.